again, Hubert and Jeanette, for reconnecting.
All right, I am ready to go. Johnny Seville, like Pebble, that's the only reason I can pronounce his name because I'm dyslexic. High probability breakout trades using free online stock scanning tools. Johnny, it is all yours.
All right, cool. Well, thanks everyone again for joining us on Black Friday. Well, I'll try to keep it as vibrant as possible. It's one of my favorite topics to talk about, actually, is scanning, because without scanning, life as a trader would seem more like a job. And I don't think anyone wants a job where they become a trader. They want a way for their money to work for them. And scanning is the way we do that. It's where technology does what technology is best at, which makes life easier. And a business partner of mine once said, Johnny, if you do the same thing more than once in a day, you should automate it. You know, if you reply to the same email with the same response 10 times, create an FAQ on your website. It only makes sense. So when you're trading, if we know what we're looking for, if we know what kind of trade we're trying to find, and we should, then why aren't we using technology to optimize and be efficient at finding what we know we're trying to find? Makes sense, right? So anyway, that's what my talk is about today, is all about scanning and how we can incorporate tools that are online, that are free, things that are available everywhere, to actually start locating ideas that we're trying to look for. So I'm going to get a little bit technical, so to speak, today. So I hope everyone's ready for that. But if you have any questions as we go through, please plug them through the chat box. Of course, the same disclaimer you've probably seen today a few times. Stock trading does involve risk. That's nothing new that I'll teach you today, but that's this covers my butt. And we will be talking about some live market conditions towards the end. So if there's any stocks you want to have a look at, here CRM was mentioned a few times. I'm actually currently holding a position in that, so we'll talk about that towards the end. But if there's any other stocks, keep them in mind. But let's get right down to it. Where am I from? Australia, Brisbane. But I live up here in Canada, and that doesn't have anything to do with my stock trading, but there you go, Ron. But let's talk about scanning. So if we're going to get into a model of trading where we are going to try and look for consistent returns, and I think consistency is the big, unspoken word that ultimately everyone wants. I mean, we love the big profits, we love the surprise earnings, we love the triple-digit option returns, but ultimately what we all need if we're going to make professional results is consistency. So to have consistency, I guess what we need to have is a consistent approach, a quantifiable, process-driven way of locating what we want. So, if you were to sit down and someone was to give you a crayon, maybe we're all grown up enough to have pens, but if someone was to give you a crayon and say, hey, can you draw exactly what a chart should look like if you were to buy it, would you know what that would be? And just have a think about that. And I don't mean just like, an uptrending chart or a downtrending chart. I mean exactly, like what would the candlesticks be doing? Are you looking for a spinning top? Are you looking for three crows? All the buzzwords. Are you looking for at support, breaking resistance? What would the volume be doing? What would the indicators be doing? Which indicators are you using? I mean, do you have it down to a science to know exactly what the chart would look like? If everyone in the room could say yay or nay, does everyone know exactly what the chart would look like and what indicators you'd use to confirm it? Because I think that in most cases, it's rare. In most cases, what people are doing is we're bringing in ideas from a number of sources: TV, news, stock reports, stock Twitters, you name it. I mean, it's such a barrage of information, but how do we quantify it? What do we do with an idea once it's presented to us? How do we decide if it's something that we want to invest in? And because there's so many different inputs with so many different reasons or rationales and strategies behind these ideas, it becomes very difficult to funnel them through an analysis process that will give us a consistent result. So I guess the idea is, we need one. we need a way to have variables that are consistent, because if you keep trying to combine everyone else's opinion, you end up with analysis paralysis, right? You end up with so many different things that are meant to work, and maybe they do all work, but not all the time. You know, soy sauce, for example, tastes great when you're cooking a wok, right? When you're having a stir fry, but that doesn't mean soy sauce is going to taste great with a birthday cake or your Thanksgiving dinner. So, I mean, each ingredient has to be used within the context within which it's meant to be used in. Otherwise, it is displaced. Not because it's wrong, but it's being used in the wrong context. So to have a good strategy, to have a consistent result, we need to make sure that we're using the right ingredients in the right context with the right market. And that's where scanning becomes, and strategy becomes very important, because we're able to then use consistent variables to eliminate noise and focus in on the high probability setups that are going to ultimately make us money. And that's what we need. So, you know, let's start drilling down and talking about what type of variables we should be looking for. Now, to do that, I always like to work from a reverse engineering standpoint. To think of it, to try and eliminate the noise, forget that the market's full of, you know, reports and job reports and unemployment. You know, forget all the stuff that's there to confuse you. And let's think about the, you know, the bare numbers, the raw data. Ultimately, what makes a stock go up or down? Well, it's volume. Volume dictates price. And once upon a time, volume used to come from value-based investors. We used to get our news from a daily newspaper, from a phone call from our stockbroker who charged us $70, $150 a trade. We used to listen to the radio to find out what was going on in the world. That has changed. So once upon a time, value meant something because that was the news on which everything was based on. These days, volume comes from somewhere else. In fact, if you've been watching the stock market for the last 10 years, you probably would have realized this already, but volume is now accounted for, 70 to 80% of it is accounted for from what we call the smart money, or high-frequency trading. Now, this was a statistic that came out 4 years ago. Anyone who watched the 60 Minutes show on high-frequency trading would have seen this similar data. In fact, the NASDAQ news service, for example, that was launched about 4 years ago, reported that over 60% of their subscribers were computers, not even human eyeballs. So when we have 70 to 80% of the volume coming from computers, all of a sudden we start to change our rationale of understanding where buy and sell decisions come from. Because a computer doesn't think of what the weather's like. It doesn't think of whether it's had a bad day or not. It's thinking purely of whether it's being told to buy or sell based on a rule, based on an algorithm. And billions of dollars are made by this. It's incredible to think about how much of the trillions of dollars flowing through the world right now come from a rule set designed in a room somewhere. Now, this doesn't mean that they have 80% of the global money. What it means is that they have 80% of the volume. So what I mean by that is if you took 100 grand and bought a stock today and held it, then you would account for $100,000 of volume. But if I take $1,000 and I buy the same stock and then sell it, well, now I'm $2,000 of volume. And if I do that 100 times, I'm $200,000 of volume, and I'm 200% bigger than you with your 100 grand. So twice the footprint with 1% of the capital. So just to kind of put things in perspective, it's the mouse casting the shadow of an elephant, so to speak. But that's how you can have big impact on market movement. And this is where we get big things like the flash crash, 1,000 points up and down in minutes. And I guess most importantly, it's predictable. Because whenever you're dealing with algorithms that are replicating themselves millions of times over, whenever something is doing the same thing again and again, you can reverse engineer it. And that's where the opportunity is. We're not trying to compete with these guys. We can't. I mean, they have They have much bigger resources than any of us combined, and they are the market. So trying to beat them is difficult, but mimicking them or detecting them is definitely possible, and that's where the opportunity is. So looking for the fingerprint or footprint of when these big players step in is where the money is. And that's what I've spent the last 10 years focusing on. Because no matter how smart I may think I am, or not, there's guys that will always be smarter than me. And I can do all the research in the world. I can try and find the next diamond in the rough, the next pharmaceutical company that's going to blow up. But the chances of me figuring that out before Goldman Sachs, before all the guys putting hundreds of millions of dollars into research, is small. Unless I get lucky once or twice. And getting lucky once or twice is not how you build a career in trading. So I guess the question I put to you is why put yourself through all that extremely time-intensive research when there's people already doing it for you? Right? And that the people that are already doing it for you is Goldman Sachs, JP Morgan, all the smart money, right? So why not dial in to what they think? And you can, if you learn how to detect it. So, and starting to detect it is the basis of everything I trade. And so that forms the basis of consistency and how we start to build a strategy from. So let's talk about developing a scan. So how does one develop a scan? Well, the first thing we need to understand about scanning is that there are 4 components to every effective scan. Firstly, we need to start with an idea or a hypothesis, to go back to my high school days. That's the only time I ever say that word is in this webinar. But yes, we start with a hypothesis. We say, listen, what is the idea? What's our underlying theory of what we want to build the scan around? And again, if you start to uncomplicate the market and bring it back to basic theory, that'll make it easy. You say, okay, well, for example, let's say we think that the market is falsely strong currently. So we're at all-time highs, but we think that we're coming towards an end. We've got open range coming up on Monday, the first day of December trading. That will set the tone for the next 3 weeks. So let's say that we hypothesize that the market is falsely strong and we're going to close down after Monday's range. All right, so we're going to start looking for stocks that are maybe starting to drop. So that's our idea. So we start building that idea out. So then we start looking at conditions. So we say, okay, well, let's start thinking about stocks that are on a weak sector. And so now you go through your sector spiders. You know, you look through your utilities, your pharmaceuticals, healthcare, etc., and look for the sector that is at resistance or breaking down through support. That's how you find your weak sector and one with negative momentum. And then we say, all right, what else can we be looking for? Well, at all-time highs, what are going to be some of the stocks that are most susceptible to getting sold off? Well, stocks at a high P/E ratio. Money managers are starting to, do tax loss selling. There's a lot of the high P/E stocks have been targets for big drops. So we say, okay, let's start looking for high P/E ratio stocks. And you know what would make high P/E ratio stocks even more suspicious? Well, if you've got a company that's selling at 500 times earnings, in other words, the company's making $1 million a year, but it's selling at 500 million. Well, that's a pretty rich sell, right? Why would a company sell at 500 times earnings? Because they're expected to do amazingly going forward. However, if something was expected to do so well going forward, wouldn't it be odd to see the people that know the company best selling all their shares? So if we can find institutional selling and insider selling on these high flyers, that would raise a flag. And let's couple that with a high price to book ratio. So now we've got our conditions. Now conditions are where the idea now gets a little bit funneled down. And this is where fundamentalists start their research. This is where the time staking process begins, because you could run this scan and find hundreds of stocks that all meet this criteria so far. So what do you do now? Now, as a fundamentalist or as a research person, now maybe you start drilling down and going through all these different companies, these hundreds of companies, deciding which one you think is the weakest. What's the worst management? What kind of business are they in? Do they have a product that you agree with or disagree with? And you could literally spend millions of hours, well, maybe that's an exaggeration, you could spend hundreds of hours going through all these companies to find the one you want. And then maybe when you finally find the one you want, you've already missed the boat. It's already dropped. You've missed the timing. Or maybe you've just missed the opportunity altogether. So with conditions, the way I explained it to somebody the other day is it's like you've detected that the core of the apple is rotten, but you don't know when it's going to drop from the tree. And that's when triggers start to come into play. Because triggers are where we now get the timing. So let's say that we've already established that the core of the apple is rotten, but now we need to know when it's going to drop, or which apple's going to drop first. And so when we start to build out this example, we can start saying, all right, well, let's suggest that the market went up 2% today. We could then, in fact, search for stocks that went down. Right? So, and at the same time, ideally have broken a key support level. And remember, if a market goes up 2% and another stock goes down 2%, assuming it's not an inverse ETF, that's just like dropping 4%. Right? So, I mean, if you're in the ocean and the entire water level goes up by a meter and you don't go up by a meter, that means you're sinking. So always think of it in relative terms. So if the market goes up and a stock goes down, it's a amplified move. And if it breaks key support as well, that's real weakness. So now we've got a trigger. Now we have a timing mechanism of which stocks may be, in fact, ready for that entry, for that short. And now, once we have an idea of triggers, conditions that confirm our idea at the beginning, now we can start using indicators. A big mistake in traders is looking for indicators first as the answer. But indicators are really an answer to a question that we have to ask. So in order for an indicator to be valuable, we need to know what question we're asking of the indicator. So in this case, if we were looking for a trade like this, we would be looking for confirmation that the breakout below support was the smart money was behind it. So we're looking for an increase in volume to show conviction in the move. We're looking for a negative MACD, because this is, if it's just broken down, it's probably been part of a descending triangle or some kind of breakout that's been building for a while. So we're looking for a negative MACD, sign of negative momentum. We're looking for a high ADX value, showing that there's movement behind the stock, because the worst thing for a trader is a lack of movement. We don't really care about direction, but what we care is that there is a direction that isn't sideways. and now we have a theory, and now we have something we can work with. So if we want to play something like that out, we can go into free online tools. For the newbie trader, there are great free online tools such as FinViz, and I'll just bring that up. We can go into FinViz. We can go into the screener, and we can build this idea out. All right, so we've got a false market. So let's say we're looking at the basic materials sector. We're going to be looking for a high P to E ratio. Let's go into all. So we're going to look for a high P to E ratio. We're going to look for insider selling, institutional selling, and there we go. We've got two stocks. And in fact, TRGP is one that I am short, incidentally. That's a funny coincidence, but here we go. So there we go. There's TRGP. So you start to see we've got a 32.99 price to book ratio, 54 P to E ratio. We've got a negative 23% on the insider transactions, negative on the institutions. And despite the analysts thinking it's worth 142, the smart money disagrees, and that's where the stock's going. And this has been actually up on this scan for a little while. That's how I found it originally. I'm surprised it's still here, but there you go. PAGP, also something that would have come up on your scan in the last few days because the conditions have been the same. There's a question. How do you know what sectors are booming or going bust? That is a great question. John, the answer to that is the same as the answer to how do you know if the market's going to go up or down. Don't answer that question with subjective opinion because everyone's going to have a different subjective opinion because it depends on what you listen to, what data you're looking at, what heads on the TV are talking, and ultimately that can't be the basis. It can be an input, but it can't be your strategy. Your strategy has to be based on quantifiable analysis. So I never ask, or I try to never opinionate, is the market bullish or bearish, or is the sector bullish or bearish? I like to use analysis. So the question you replace that with is the sector at support or resistance? If it's at support, and the momentum is going up, buy it. If the sector or the market is at support and the momentum is going down, wait for the break and short it. Same thing if it's rallied and is at resistance. If it's at resistance and momentum is going up, look for the breakout, look for the longs, look for momentum trades. If the market or sector is at resistance and you've got diverging money flow, short the hell out of it. That's how I approach things. So the thing that keeps me sleeping well at night is I never have to think too hard about how I feel about the market. Feelings and opinions have really no place. If you subscribe to Jack Schwager's thought process, it's Market Wizards. It's all about having a convicted endpoint based on your strategy. So we'll have a look at that later on about how you go through that thought process. So this is an example of building out just this very basic idea, and from that you could have had two really good shorts today, where you've got a big drop on both stocks. And we'll actually bring up TRGP later on because that's an interesting example. So this is how you build an idea out. And generally, you're going to have lots of different possible ideas. I mean, if you're looking for value stocks, you could be looking for stocks that have a low price to share ratio, a low price to book ratio, with a dividend yield, say 5 to 10% in a really strong sector. If you're a short-term trader, you could be doing other things. And I'm going to share some other ideas here with you in a moment. But basically, once you've now built your idea out, the idea is then to put it through the same funnel. So no matter what your strategy is, here's your checklist that you want to then start using to qualify it. So I talked about this a second ago. Is the stock market bullish or bearish? Replace that with, is it at resistance or support? Then once you figure that out, which sector is the most bullish or bearish? Or in other words, which sector is at support or at resistance? Then we run our correlating scan. So then we build our idea out, whether we're looking for bullish or bearish moves. Then we start to look at, is the stock approaching smart money levels, which we'll get to in a second. So where's the smart money going? And if that confirms the trade, now we start drilling down further. Now we have our short list of stocks that we're interested in, and we start saying, hey, what's price action saying? And is that price action confirmed on multiple time frames? Okay. Okay. All right. So I've got trades selling in the background over. All right. So now finally, do indicators confirm? So this is now when indicators have a role, because now we know we've done our detective work, and we've said, okay, we've found what we think is a good trade. We've looked at the dynamics of it, the DNA of it, and now we think we know what's going on. So now let's look at some indicators that can further confirm the relationships in that data. And that's where indicators can be powerful. And then finally, is there any special ingredient that gives us an edge, such as a big institutional buy or a big insider buy or something like that? And then, so once we know what we're looking for, and that sounds strange, right? To be trading our finances in the market without knowing what we're looking for? That's very strange. It's like going into New York in a car, searching for a restaurant, and having no idea where it is or what it's called, just hoping that we drive past it. That's what most people do in the stock market. It's ludicrous. You should know what you're looking for if you are going to trade the stock market. And once you do know what you're looking for, it's easy. And that's where technology becomes very powerful. We can scan for exactly what we're looking for in seconds. And then because we know what chart we want to see, we can look through those 10, 20 displays and say, yep, that's it. And when I used to consult on some hedge funds in Sacramento, they used to have the same philosophy. They would call it the blink test. So the blink test. So if it took you longer to analyze the chart and see if you saw something you liked than it took you to blink, then move on, because it wasn't obvious enough to be a high probability trade. So this is where the basis of really good trading comes from, is knowing what you're looking for, knowing how to identify it, and then developing scans to do that labor work for you, so you can focus your time on searching through high quality trades versus going through garbage. So again, bullish or bearish, support or resistance is what we want to be looking at. And of course, this relies, your ability to do this means you need to know how to draw trend lines and identify trend lines properly. But once you've done that, it becomes much, much easier, because you can see the roadmap. Now you're not searching through New York City. Now you know, now you've got a GPS to be fickle. Now you know where to go, because you can see the guidelines on the chart. Now, where we start to get even more interesting is now once we take these ideas, these kind of condition-based ideas, these kind of general scans, and then start combining them with patterns. So looking for, for example, double tops, double bottoms, head and shoulders, inverted head and shoulders, and the key thing here is to focus on the patterns that have the highest probability. Because every pattern has a different probability. As Hubert said earlier, we just came back from the Las Vegas Traders Convention, and I remember sitting down at a table and watching these people playing cards, and the bloke next to me pulled out a 6-2 offsuit, and he put in $500. And I looked at him, I said, "You must be nuts." He said, "I'm here to have fun." I looked at his chip stack, and it was fairly sizable. But I thought, well, you're here to have fun, or you're here to make money, was what I was thinking in my head. And I think that's what traders do. We often put off our losses and say, well, you know, that's okay. This is just a hobby anyway. Well, that's garbage. Even if it is a hobby, the hobby is much more fun if you make money. So why would you play garbage suits? Why would you play a garbage hand? Know when to hold them, know when to fold them. And in the stock market, knowing when to hold them is understanding whether you have a high probability hand or not, which means you need to understand the probabilities. And in the stock market, there's maybe 60 plus commonly regarded patterns. And each pattern has a few different things about them. They'll have a degree of probability of success. So let's say, for example, a double top, so up in the right-hand corner, might have, say, a 65% probability that at the second peak it'll drop. It'll then have a percentage of profitability. So when it drops, out of every 100 trades, out of every 100 patterns you trade, this will be the average retracement or profitability. And then the third thing is also predictability, because you can have a really awesome pattern that you like to trade, but can you find it reliably and consistently? Consistently, again, key word. Because if you can make 1,000%, great. But if you can only find that trade reliably once a year, again, you can't build an income strategy around that. So PPP, profitability, probability, profitability, and predictability are the three things we need to find a good combination of. So here's some examples. Fallen angels, very high probability, very high profitability. These are, if you can predict them right, these are stocks that have had a massive drop that are scooping at the bottom, and you get them kind of like a hockey stick or a ski jump. These are awesome trades, one of my favorites. So this is one of my favorite types of scans to do. You can also look at downward channels, which often revert to the opposite angle of their movement. And then here we're obviously dealing with breakouts and oscillation. Upward channels, obviously the reverse. Double tops. And there's a difference between, this is an atom and atom double top, which is, I rate a 13 out of 50 in terms of favored patterns. But you can also have Eve and atom double tops, where you get a scoop-like pattern, and these are much less probable. So there's a big difference. If you get a spike on the left shoulder, higher probability. If you get a rounded top, I wouldn't even trade it. So again, understanding the differences is key. Head and shoulders, one of the higher ranking. Again, one of my other favorite types of strategies. I mean, look at some of the breakdowns here recently. I'm just going to flip over to my live charts here for a moment. You know, let's talk about things like, I've got Salesforce up here. We'll come back to that one. Let's look at IBM. IBM was one of the most predictable drops, and we called it. We in our trading room, we picked the 170 puts ahead of earnings. Why? We'll come back to the more advanced reasons later, but on a very simple basis, this was a head and shoulders pattern. On the longer time frame, left shoulder, head, right shoulder. You measure from the head to the neckline, and we extend it out from the break, and there you go. A drop from 184 down to 162. And plus, ahead of the earnings, with this understanding of the price action and patterns in mind, it had already broken that neckline before the earnings, which made it even higher probability. Highly predictable, and if you were in on the puts, you would have made up to 800% in a 24 to 48 hour period. Let's look at Twitter. Another one we picked for the same reason. You got a head and shoulder pattern, and this one's even better. Not as good in terms of results. This was only a 300%. We bought the puts at 290, and I think we sold them around 7 something. I can't remember, but it was something around that. But again, look at the head and shoulders pattern. Right? So starting to understand the probability is ultimately the key, because if you don't know what pattern the stock's in, then you have no clue what the high probability move is. So starting to drill down into some of these things, pennants, another thing I like to trade, and flags, one of my favorites as well. Flags, head and shoulders, fallen angels, and strong reversal patterns are basically all that I trade. So, and then once you've got that down, then you start confirming on your multiple time frames. And basically looking at one time frame either side of the trade. So if you're a swing trader, looking at the hourly chart to look at your entry point, and then looking at the weekly chart to look at the macro scale pattern, is going to ultimately give you the best correlation on trade. And then, as I said, then you can start getting into your indicators, because now these are just the plus side. Because ultimately, everything you need to know about a chart is already on the chart. There's only 3 things you can analyze on a chart. Anyone know what they are? We'll take a stab at it. 3 things that a chart can look at. Anthony's got it. Time, price, and volume. So every fancy indicator in the world is only looking at some correlation of those 3 things. All indicators are doing is making relationships out of those 3 things. But once you start to get intimate with those 3 things, indicators start to lose their value, because you can see that relationship after you've spent enough time in front of it. Now, I mean, I've spent tens of thousands of hours in front of charts, so it's easy for me to say that. So when you're starting out, indicators are very valuable because they help you to see that relationship. But eventually, you'll start to see that relationship yourself. So some of the indicators that are useful, Bollinger Bands, are great for looking for reversals when they pierce the band. CCIs are useful for reversals as well. RSI, also useful for reversals. Stochastics. But all these types of indicators ultimately are trying to tell us one very important thing. Where is the smart money going? Because that is what will ultimately make the stock go up or down. So how do we find smart money? Well, let's come back to a really basic technical definition. What is the definition of an uptrend? What's the technical definition, everybody? I want to see the hands up here. Don't make me get the ruler out. What's the technical definition of an uptrend? There we go. Anthony's in there again. Good job. Exactly. Higher highs and higher lows. All right. But let me challenge that idea. Let me be unconventional and say that is wrong. Let's just take this chart off here so I can scribble myself. Let me challenge that. Because if a stock was doing this, that would be higher highs and higher lows, wouldn't it? But wouldn't that also be a rising wedge, which is bearish? That's certainly not an uptrend I would be looking for to buy. Let's also say that you found this. Let's say that you were making higher highs and higher lows, but That's what it was doing. I would also not be looking for that unless I was looking for a short. Well, let's say you're making higher highs and higher lows, forget where it's closing, but as it does that, the volume's dropping by 50% a day. Is that something you'd be interested in buying? I wouldn't. So let's redefine what an uptrend really is. An uptrend is higher highs, higher lows, increasing volume, and closes in the top half of the range. Now, does anyone know what indicators each of these three things is accounted for by? Higher highs and higher lows is directional movement. Directional movement plus and directional movement minus. That accounts for, is the stock making higher highs and higher lows? Is increasing volume with price movement is on balance volume. And closes in the top half of the range, well, that's stochastics. So we're populating our entire chart with all these indicators, but ultimately all these indicators are doing is trying to define for us if an uptrend is really happening or not. But do we understand that? Do we understand when we put these indicators on our chart what they're ultimately trying to show us? Or are we looking for a magical answer where we don't really know what the question is? Because that's the problem with technical indicators, is that we rely on them for this magical answer, but ultimately all they're doing is they're telling us something very simple in principle, which is the smart money there or not? So understanding the smart money is where things start to get fun. So when we go back to trades like IBM, you can incorporate an indicator such as money flow. And I've got the wrong one on here, 1 second. I use a few different types of money flows. For swing trading, yeah, here we go. So we've got money flow. So money flow, for example, is one of the indicators which indicates the presence of smart money. It looks at all of those things I just mentioned occurring. And when you have situations such as this, where the money flow has dropped way down. If you look at the price here, 185. Look at the previous time it was 185. Money flow was at -5. At the same price, we're at -18. So at a higher or equal price, money is flowing out of the stock, or the smart money is flowing out of the stock. And if you went and had a look at the insider trading on IBM, not only did we have a bearish pattern, not only did we have bearish money flow, but we also had a very high presence of insider selling. The same happened with Twitter, the same happened with Capital One, the same happened with, gosh, what was the other ones? Anyway, there was a bunch of them, but all of these ones were ones we picked for options during earnings plays that did very, very well. And it was all based on the same kind of principle. So when you start to incorporate all of these things, now we're really tapping into the smart money, because this is how it plays. The smart money plays with a playbook, much like a football team, right? I've only just started to understand football after living in North America for about 12 years. It's starting to make sense. So apart from cheering loudly and spilling my beer on the floor, that's the crowd around me. Now I start to see the patterns in the game. And much like the stock market, in a football game, the coach has maybe 50, 60 different plays to choose from. In the stock market, it's the same thing. And it's not chaos, it's organized chaos. And by understanding the probabilities of these patterns, you can play to that probability. Okay? And this is what I'm trying to get at, is that this is where the real money is made. So let's, I promised you another scan. So let's talk about another one. Let's talk about contrarian trades. Again, we'll go back to FinViz. Let's talk about short floats. So, and this is just another example. This is a very basic scan. What happens when a stock is shorted? What happens when it's heavily shorted? Well, eventually, you have to cover. Right? So, the question then becomes, when? How low will it go? So, the time that the stock's going to be starting to get covered, the time where it's going to have some support, is going to be when it reaches a point where the smart money, the algorithmic trading, starts to kick in and buy. And when it starts to buy, any kind of substantial rally will trigger short covering and what we call a short squeeze. Now, we are not looking for a company of any substantial value here. We don't care whether it's going out of business or not. All we're looking at is there a point where there's going to be enough buying that will trigger a dramatic short squeeze. So what we're looking for is a very high short float, above 25%. What we're looking for is institutional buying, insider buying, and a strong bullish pattern. And you can build this out in FinViz. And for anyone who follows our executive summaries that we publish online, this is the one of the scans we actually used to find this stock that we picked on Wednesday, RXII. I think it was a 66% short float, I believe. It was at least above 30. There was a few of them we picked with the strategy, but this one had a very high short float, but it had insider buying, institutional buying, and so we picked this for a 10% rally, and on Wednesday this went up 15% in one day. Now this is only trading about $1 million worth of stock, but I mean for a $5,000, $10,000, even $500 play, you can't argue with 15% in a day. And this was easy. This was a no-brainer. I don't trade penny stocks. The question is, why do I trade penny stocks? Most of the I don't differentiate between penny stocks or large cap stocks. Obviously, I mean, as somebody who likes to trade options, I usually prefer the large caps because that's where you're going to get the option chain. But I mean, the benefit to mid cap stocks, remember, if you look at Fannie Mae, I mean, that was trading hundreds of millions of dollars a day, and it was only a couple of bucks. So that the price of the share doesn't matter. It's the volume that counts. Or what I call the value. So take the amount of shares traded multiplied by the dollar value of the stock, and I'll look for a stock that trades at least $1 million a day for speculative trades, where I might put 10, 20, 30 grand, 5 grand, 500, whatever the case might be, where you can easily get in and out. If you're going to be dealing with large investments or longer-term holds or things where you really need liquidity, I mean, obviously you're going to be dealing with much higher value. But this is the kind of thing where you can get a short-term play. But I mean, if you look at something else, Aaron's was another one that came under the same parameters. This is a larger cap stock, but same strategy. You had a breakout of the downward channel. And as I mentioned earlier, downward channels usually revert to the opposite direction. So you can see the breakout there. You can see the smart money divergence. So as the stock was dropping, smart money was accumulating a position. And then as it broke out, so too did the smart money indicator. And this was also one of our picks on our executive summary reports for those who follow. So that's a nice little pop. This is another example. Cons. C-O-N-N. Same kind of thing. So obviously choose a stock and choose a volume level that's going to give you safety based on your own risk requirements. I'm not suggesting you trade $2 stocks or $200 stocks, but pick something that's right for you that you feel comfortable with is most important. But always think of the fact that to me what matters most is volume and liquidity. Now I'm happy to bring up some other stocks here in a moment, but the most important thing now is if we want to get even smarter, now we can start correlating not only high probability patterns and high probability support and resistance, but then correlate that with the sectors and markets, and looking for, using very similar tactics, situations where everything is matching up. So Aaron's is another example. We just talked about that. In fact, this is a great example of an oscillating stock where it's bouncing between key support levels, and that was one of the examples I was just showing you on the live charts. You can see big moves of key smart money areas where we've got 30 million bucks a day, high liquidity, where stocks are moving on massive amounts of money from 26.50 to 32 and straight back down again. 26.50 to 32 and straight back down again. Why? Why is such a powerful move possible? Because it's all coming from this presence of that 80% of volume that represents the smart money. The symbol for Aaron's is AAN, Alpha Alpha Neptune. Gosh, I've forgotten what the phonetic code for N is. Somebody help me. Okay, Normandy, November. All right. N is for Nancy. It's a good thing it's not a phonetic alphabet test today, eh? Anyway, my main point today is that scanning makes sense. It makes efficiency. If anyone who's read the 4-Hour Work Week, Timothy Ferriss asks this question. He says, "Who is the wealthier man, the guy or woman, the guy or lady who works for 100 grand a year, working 60 hours a week, or the person that makes 60,000 a year, working 10 hours a week?" And of course, the argument is the latter. So, in terms of the stock market, is it feasible that you can make more money spending more time? Sure. But how much more for how much more time? What's that ratio? And you know, just to use this example, by scanning, yes, you might not capture every possible trade out there, but do you really need every possible trade out there? Or do you just want enough high quality ones that you can make money, make an income, and then free more time up to do what you want to do? Again, I would argue the latter. And that's what scanning is designed for. Whether you're going to do it for day trading, whether you're going to do it for swing trading, whether you're doing it for long-term investing, and even if you do want to spend 6 hours a day, spend 6 hours a day efficiently, focusing on high-quality opportunities. And that's basically the whole pitch of today, and I hope you found value out of it, because I really believe that scanning is important. And one of the things that we're going to do to follow up with today's workshop is something I think I'm extremely valuable. Basically, on Thursday next week, we're going to be doing a workshop, 2-hour workshop, where we're going to be teaching you the scan that I use every single day, amongst other scans, where we're going to be focusing purely on where the smart money is going. It's something that I do not trade a single stock without. It's what I run every single afternoon, and where the majority of my trades come from. We're not going to teach you 50 different scans. We're going to teach you a couple of very, very high probability scans that you can use immediately. It's something that we've used now in Acorn for about 3 years, and the previous 7 were years I wish I had it. Because again, once you've got scans, you have a start and finish to your research. You're not sitting there for hours. You get in, you run your scan, and you go through the 10 stocks that come up, and you're done. And you can then say, my day's over. So we'll be going over the highest probability patterns It will be recorded, absolutely. And not only will it be recorded, but if you aren't able to attend live, we'll actually invite you to every time we redo this workshop. So the next one will probably be in late January. So you can re-attend any of our live workshops in the future as a member of this workshop. So we'll be going over the highest probability patterns, how to identify them properly, and that comes back to trend line drawing and understanding where a chart starts and finishes, core characteristics, entries and exits. I'm out of time here, so I'm going to skip towards the end. But it's a pretty awesome workshop, and I hope that you guys will join me, because I love teaching it, and I'm sure you guys will get a lot out of it because you can use it straight away, especially going into next year. Yes, we use FinViz, and the other tools we use, which we'll be showing you, are also free, so you don't have to buy a program at the end of it. And I'd love to have you. And with that, I will pass it back over to Hubert. Again, thanks everyone at Trade Thirsty, Jeanette, Hubert. It's a pleasure to be here.
Thank you, Johnny. Thank you very much. All right, let's see here. So let me give you Johnny's link one more time. Let me grab it here. acornwealth.com/start. I will paste it in here for you. Boom. Send to all, and also put it in the chat box there. All right, so give me 3 or 4 minutes to stop the recording and then restart the recording, and then we'll start again. Okay, so all the speakers are done. Only thing you're staying for now is me. I'm going to share some really cool stuff with you. I'm going to show you how to make money on bonds, and then I'm also going to show you how to actually use Ichimoku. So we've had a lot of other speakers to show you how they use it. I'm going to show you exactly how to use it. I'm going to break it down in the simplest parts. I'm also going to show you how to trade bonds. Okay, so just give me about 30-40 seconds, and I'll be right back. Oh, here.